Katie, it's great to see you. Like Emily and Ines were just saying, so much happening in the markets over the last several weeks, so many earnings to look forward here to over the next couple of days. Certainly has been a down couple of months for the market. You focus on the technicals. What are you watching today?
You know, what's important is that throughout this earnings season, we've seen oversold conditions widespread from a technical perspective, and yet no reaction to it. The S&P 500 was down 8.8% in the month of April. And of course, the month of April was the start of earnings season. So not a favorable reaction collectively from the market to the earnings that have hit the tape so far. Those oversold conditions are still in place, and yet so is downside momentum. So the major indices are now below some key support levels that we're watching, 4,200 for the S&P 500 roughly, and also about 13,000 for the NASDAQ 100. To the extent that they confirm breakdowns below those levels later this week on another weekly close below, that to us would increase risk that this is indeed more than a corrective phase, something that's a bit more like a bear market move that could be prolonged.
So then are we nearing the end of this pullback? And what are some of the signals that would indicate whether we are or not?
That's the $100,000 question, right? We all want to know, what it looks like when this ends. And I think that's right to think about things in those terms, because what we tend to see when the market bottoms after this kind of downdraft, just about everything bottoms are right around the same day. So if we can have an understanding of what the market might look like then we really can help ourselves get a better entry for these individual stock positions. What that tends to look like in our work is that the market internal measures, things like breadth and sentiment and leadership, hit these oversold extremes that are rarely ever reached. And we have a few of those are already there, but not the collection at which we really tend to see these major intermediate term lows established. So we like to see those market internals in sort of that green territory, but then we also like to see a reaction to oversold conditions. And that's not just in a short-term manner, but also an intermediate-term manner. So we want to see some support discovery following an oversold reading. So that kind of process takes a bit more time. It is hard sometimes to identify those lows in real time, but we also have some overbought, oversold measures that tend to get us a little bit closer to that inflection point. So we're going to focus on all of our technical indicators and just try to put the odds in our favor in terms of identifying that low when it seems to be unfolding.
Katie, the 10-year Treasury hit 3% earlier, first time since 2018, which tells you what?
Well, I mean, the uptrend there has really accelerated, and I think that's established that they're going higher. And it's not news anymore. But if you had asked somebody a year ago or so, they might question that. So we know that this uptrend is very much in force and intact and has momentum behind it. The 3% level isn't really significant in my work, but it does get the 10-year Treasury yields closer to that 2018 high, which is indeed the next resistance on the chart of about 3.25. So that to us is the targeted level from the latest breakout. Importantly, that latest breakout that we saw reversed a multi-decade downtrend channel for Treasury yields. So that tells us that even though we can expect at times corrective phases, that we should see this long-term uptrend that was established a couple of years ago persist in the coming years even. So I think it's our new normal, something that we'll have to become accustomed to. And there is no magic number for equities, but already we're seeing not a great reaction, of course, from technology in particular in terms of the underperformance that we've seen there of late.
Hey, Katie, a lot of investor focus over the next 2 days is going to be on the Fed meeting and what exactly is going to be announced from Jay Powell on Wednesday. How are you thinking about this? And not so much, I guess, how investors should be positioned, but how much of this do you already see priced into the market?
Well, there's no doubt that there's some anticipation out there of their comments and their actions. So we're seeing that in the marketplace. It's very, very skittish and probably reasonably so. We do put a lot of weight into reactions, right? We want to see how that kind of news is reacted to by the market. Does it drive a breakdown, or have we already broken down ahead of it? That type of thing. So we really focus on the market action around those types of events, which are very widely publicized. I think we all kind of know what's coming, and yet sometimes that doesn't matter. Sometimes the market comes into it and it can be deeply oversold, and yet there's just some disappointment around the language, that type of thing. So even when you think something might be built into expectations, I think it's a pretty risky assumption to make in this kind of environment, especially that is so top-down oriented. I mean, there's hardly any stocks that have been unturned by the recent weakness. So I think we have to keep those risks in mind as we come into the numbers.